So we've been watching and talking, Doug, a lot about the wildfires, obviously, in California, and it brings up kind of this larger conversation. You and I actually had it on TV recently about insurance, because they have an insurance crisis out there, which they did before the wildfires. But now you start to think just generally about insurance. And since our podcast is one about financial literacy, instead of getting into like every debate about, what the insurance market should look like in the country, which is totally different, or even talk about health insurance, which again is totally different, we can focus right on what you need to know about homeowners insurance. We can talk a little bit about auto insurance, life insurance later on as well. But
Sure.
you mentioned it on the air when we were on TV together that this is something people just don't think about until they have to.
Yes, a lot of times it's a requirement for you to get your house for your mortgage if you're taking a mortgage. And so people
Right.
say, what's the minimum amount I need to get this? Because they're trying to save money, especially when you first buy your home. And so that's fine when you get in, but things happen over time where it needs to be reviewed. And many people have never even reviewed it, let alone even understood the basics of it. And so in its simplest, homeowners insurance is really covering four incidences, and it's sort of interior damage,
Right.
exterior damage, loss of personal, belongings, and then any injuries that may occur on your property. Those are the four major incidents that it covers. So it's important to understand what you are covered for. And then as time goes on and the values change in what you do to the house and just overall, it does make sense to take it out and understand what you do have. So if there is a claim that you need to make, you know what you have to deal with.
All right, let's break this down a little bit because, certainly some of this, as again, to go back to California, depends on where you live, or Florida when there's a hurricane depends on where you live and the type of extra insurance that you might want, whether you can attain it, whether you're eligible for it, and all of that. But just on a very basic level, I know that there are three basic levels of coverage, right, that people should think about. One being the actual cash value, two being the replacement cost, three being the extended replacement cost or value. So let's go
right.
through that a little bit and see, what people's kind of mindsets should be for homeowners insurance when they
Sure.
when they buy a house, in your view.
Well, sometimes in trying to save money, one of the ways that they do that for you is they put you onto actual cash value as coverage. And what that says is that if you did some work 10 years ago and bought something, then all that is going to be replaced is what the depreciated value of that 10-year-old asset is. So it doesn't keep pace with the current replacement. And so
Right.
that's why a lot of times they tell you, hey, take replacement cost, because at least it's going to be the current replacement of your bathroom, not what it was 10 years ago.
So that'll
And
cost you more, though. I'm sure the premiums are higher for those versus the first.
That's right.
Right.
And so, but you don't have to necessarily worry about it the depreciated value and coming
Yeah.
up with the difference. And the only difference between that and the guaranteed or extended replacement cost is that that's really to cover you for inflation. And so it's, if things are, typically it's a 20 or 25% excess coverage, so that if suddenly, materials are hard to come by because they got suddenly more expensive, you don't have to worry. It's going to absolutely cover the full amount, including any appreciation that may have happened since the last time that you had your policy updated. And a lot of these insurance companies will update the values based on what they think replacement of your home would be, but it may be off. And so there's a lot of issues with that in terms of the current values of what you're covered for. If you take out your policy and see what the value of your house is in a replacement value scenario, you probably know already whether that's going to be able to rebuild your house or not. And if it's not,
Right.
that's one of the things you need to look at.
So that's one of the first things you need to think about, or one of the first things you need to look at. The other thing I think is interesting about all of this is that, and maybe you see this with your clients, is that I would think years ago, the more basic coverage for a lot of people would have made sense for more people than it does now. In other words, that, and I know people get worked up when you talk about climate change and those types of things, but just if you think about it just from a logical perspective, if you watch the news and what's happening, is that there seemed to be a lot more violent weather events in areas that weren't used to them. I mean, we went through it
Yeah.
years ago with Sandy, and it was, I think
That's
it was
right.
I don't remember anything like that in the New York area where we both live, maybe going back to like Hurricane Gloria in the 80s.
Yes.
There was nothing like that. So now you see a storm like that in New York, New Jersey, in whatever it was, 2012. And then ever since then, every year, something, boy, that look at that. That doesn't happen there as much. Oh, that hasn't happened there before, or this is the worst it's ever been.
Right.
So I think about someone with homeowners insurance that's
Mhm.
trying to kind of gauge out their own risk. What do you tell people in terms of how they should know if they want to take that next step or pay a little bit more when it's
Sure.
worth it, you know?
Yeah, it's almost like when it's been too calm in your area for too long, it's like
Right,
maybe
the
that
odds.
area's
Yeah,
yeah,
right.
the odds increase. And so, but there's a couple of things that people have to know that are not covered. So for instance, in California and
Yep.
related, earthquakes are not covered. So that's an additional rider or an expense. People think maybe that should be covered. Now, fires are typically covered. Now, the other interesting thing that may or may not be covered, no matter where you live, are floods and
Floods, right.
water. And so if like for instance, if your toilet had a problem and flooded your house, that's an internal issue. That is going to be covered. But external floods, like if the water rose, and that was the problem with Sandy and other areas and hurricanes. If it's an outside event, that is not going to be covered by your typical homeowners insurance. That's where you're going to need flood insurance. And so places like Florida are having that problem because the high propensity for flooding from those outside events, not the internal ones from your,
Yeah.
your own house, are not covered, and you require an additional insurance. Now,
And obviously, you live near the water, you want to do that. Whether they'll give it to you or not, I guess, or how much it costs, another scenario.
that's right.
But I just wonder about other people who don't live right on the water.
Yeah,
Like, you and I just use examples. We live
Sure.
on an island that has
Yes.
water surrounding it, but some people might live right on the ocean or right on the Long Island Sound or right on a bay, and others are right in the middle of an island, but
That's
there's not
right.
really water
No.
near them. So they're thinking, should I try to get this, or is it worth it for me to think
As-
about upgrading?
So, and these are decisions you make. It's nice to live right on the water, but
Sure.
I've chosen to live 200 feet above sea level, even though I'm on the island. So
Right.
a lot would have to happen for my house to flood. But people do live on the water, and that's lovely. But here's the thing that you really want to think about is there's something called the 80% rule with homeowners insurance. And what the insurance company will tell you is that as long as you're covered for 80% of the current replacement value, they will cover 100% of the replacement. And so here's where this can trip you up, even if you think you're covered. So as an example, if you bought your house for, let's say, as many people did in California as an example, for $500,000, and you had the 80% coverage, so you had 400,000 of coverage,
Okay.
and it's 10 years later, and the house is worth $1 million. But let's say your insurance coverage, even though it went up, it was only up to 700,000. So it didn't kind of keep pace. You had 400,000 of coverage when it was 500,000. That's 80%. So you're fully covered. But now with the house being worth $1 million, your coverage only kind of went up a little bit because we want to keep the cost down to 700,000. Well, now if the full replacement was $1 million and you're only covered for 700, you haven't met the 80% rule. And what a lot of people are going to find here and other places is that when they go to rebuild the house, because they didn't have the 80% number, the insurance company now legally is only going to cover you for, in this example, 700,000 out of $1 million is 70%. So they're
Right.
only going to cover you for 70% of the full rebuild.
So you out
even
of
though
luck
you
there,
thought
or
you
maybe
had.
FEMA comes in. I mean, in those situations, you might
That's
get
right.
disaster help from the
You
government,
might.
right?
And a lot of people did
might
here.
being the key word, or it might take forever. Also, I get it. So
That's right. And as you know from Hurricane Sandy and
Yep.
around here, it took years and
Yes.
years. There's some immediate relief, and I think that will happen. But then there's a long-term relief, which just you could be fighting for years before you rebuild. And that now you get into other things like does your homeowner's insurance cover house and home rental while you're being rebuilt? Many of them do, some don't. So you need to look in there. Would I be able to be put up somewhere for a long-term rental in another home or similar? Is that in my policy too? So those, not important until it's super important. And that's why you want to get out that policy, see what am I covered for? Is it meeting the 80% rule if I'm going for replacement? What am I covered? What am I not? Take a look and see what are you covered? Now, there's ways to save money while you're trying to be fully covered and not just let it go crazy, because the insurance company is going to raise it up every year. But it's something you do want to look at.
Yeah, I think if people take nothing else away from the podcast today, it's like the 80% rule might be the headline. It's like, all right, let me think, because it's an easy way for someone to say, all
Hmm.
right, here's what my house is probably worth. I got an idea in the neighborhood. Here's what I had. Let me do the math real quick. Just something easy you could do, simple
Easy.
you could do in your own house. Tonight, just take a
You
look
could.
and use that 80% that Doug
And
is
it's one that you may have had when you bought the house, but now the home
right. The
prices have
update.
appreciated.
Right.
Yes, and insurance company was trying to keep you up with that number, and you were like, "Hey, can I save money?" And they're like, "Yeah, you could save money," and then they push it down, and you realize you just jeopardized yourself. And so those are the things you want to just be very conscious of.
I want to get into auto insurance in a moment. Like we said, we'll talk a little bit about life insurance as well. One other thing on this before we go, or little ways, then there are a few. I know that you can save a few bucks on these policies if you've done certain things. Like, is it people with alarm systems, for example, right? Isn't that one way? There's
That
ways
is
you can think about it if, and again, obviously everything has a cost, but you might say, well, this might
right.
be worth it for me because if I put it in now, I'm going to stay in the house for a long time. What are some
Sure.
ways people can save a few bucks?
So there's certainly in homeowners tying into a security system is going to lower your premiums. You can also, and this is home or auto, you can look at your deductibles. Now, just coming back to home for a second, some of the newer policies switched from like the typical $500 or $1,000 deductible to a percentage deductible, which, on a $500,000 home, a 2% deductible now instead of a dollar amount might be $10,000. And so that's another way to keep costs down. But if you're really worried about the extreme events, those are ways that you can keep the costs down rather than having the straight, dollar amount. But in auto, a lot of people automatically default to a $100 or a $500 deductible. And it may not make sense, but it's certainly worth considering looking at $1,000 deductibles, because you're thinking, if my car's a total loss, I'm not worried about the first 1,000 or the difference between a $500 and $1,000 deductible. And a lot of times, this is what happens with auto insurance. Let's just say that the bill is $1,000 to fix your car, and you have a $500 deductible. This
Right.
I see a lot. Are you going to put in a claim for that $500? Because if you do, that difference between what it costs and your $500 deductible, if you do, that's an incident. And if you have multiple incidents, they're going to jack up your premium.
Up the premium. It's always something you got to think about. I mean, I had it
Exactly.
with my own car something happens. You're like, I don't know if it's worth it because I might as well
Right.
just pay for it
It's
myself.
going to hurt you in the long run. So if you know that, then maybe take the $1,000 deductible. Now, the difference in cost might not be worth it. It might be a few dollars a month. But if it's substantial, if it's a newer car and you're thinking this through, you're saying that's a way to save money. And then another way to save money is a lot of people have their homeowners and their auto insurance at two different places. And
Right.
many insurance companies will not what we call wrap that together to give you a discount. And so sometimes, even though independently, each of these might be cheaper with the way you have it, I would go to each company, go to your homeowner's insurance company and get an auto quote, and go to your auto company and get a homeowner's quote and say, hey, if I bundle these together, you see
Yes.
those ads with the bundling, that's really key. They will say, yeah, we're going to give you a discount and you might end up cheaper. And then you might want to add in some other rounded protections that make it even cheaper by having it all at one place.
Well,
So
that
you
brings
do
up a
get-
larger point, I think. I mean, we did that a few years back, or I don't remember how long it was, but we did that and got quotes, and we're with the same company for all of them now. The one thing I would say as we get into auto insurance is that I just feel like in parenting manuals, you know how they do like how to be a parent for dummies or whatever, they should just tell you. And when you're having children that, think about this because one day they're going to drive and you
Right.
might not be able to afford it. So
the teenager chapter, that's the one.
Yeah,
that-
right. Think about if you really want to have these children. I would argue that they're probably still worth it, but the idea that three of mine are right now driving and I'm paying for all of their insurance, or
Right.
my wife and I are, is that's something
Yeah.
to think about. Just have it in the back of your head. That's all. And then so what we did, and then you can tell me, as you always do, whether it's a good idea or not, is that when you're talking about getting with one company, it also we didn't have it at first when we first got married, but we got a big kind of umbrella policy as well,
Right.
try to protect ourselves. It costs more, but
Yep.
we think just in case that might be worth it
Yeah.
also. So you talk about a little bit about umbrella policies, what you tell
Sure.
people
I
about
see
them?
this a lot. Like, so a typical auto policy, depending on what state you're in, the minimums might be, it could be 25,000, 50,000 total. Some are 100,000 or 300,000 total. But let's just say that you're worth $600,000 as a couple. You add that up, you're saying I'm worth 600,000 and your auto insurance only covers up to 300,000. Well, technically, you're on the hook personally for what you would get sued above 300,000 for your personal assets. And
Right.
so one of the easiest ways to do this is to do what's called an umbrella policy, and it further wraps your auto and your homeowners in case somebody slips and falls, or your dog
Yes.
bites somebody, or your kid gets into an accident. And it wraps it with, let's say, $1 million, by the way, wrapped around auto and homeowners at one company might just cost you the amount of the discount you're getting. It might only be a couple of $100 to protect yourself up to $1 million. And I would say if you're worth up to $1 million and you have lower than that coverages on your auto, you don't realize it, but you could be personally sued and liable for that difference. And so it's worth a very small amount if you're worth something more than that amount that's on your auto insurance. But you don't have to put that liability on your auto insurance where it would cost you more. You could wrap it in an umbrella, and they will give you a quote on wrapping the whole thing. And then you don't have to worry about. Now, of course, if you're worth $2 or $3 million, then you might have to up that umbrella. But many people that are at that $1 million amount or just below it are exposed and don't realize. And that's a very, very inexpensive add-on for that first million on top of when you've bundled everything. So it's
Well,
really
that's why I
something
was
to
saying
look
we
at.
didn't have it at first, and it's something people don't think about when they're younger as much, because to your point, you don't have as much money, and you're not
Right.
thinking about
Exactly.
as many things. And then when you start to maybe accumulate a little bit more in your bank account, but also your children are getting old and they're doing more,
Sure.
and they're taking on driving and the like. There's just more. There's more
risk.
More risk, right? So there's more reasons you could be sued or could be liable,
And just
or
one
something
other
could
thing,
come up you haven't thought of.
when you're looking at your auto policy, and this is very different state to state, there's something called uninsured motorist, which means that if somebody, crashes into you that has no insurance, that now your policy will cover somebody else's lack of insurance. And
Right.
there are people driving out there that don't have insurance.
Yeah.
So you can't sue anybody other than them, and they have nothing if they don't have insurance. So uninsured motor you might have. There's something also that not a lot of policies have without asking. It's called underinsured motorist. So let's say you slam into somebody and they just have the bare bones minimum. Now in New York, I think it's 100,000 minimum. Maybe other states might have 25. Somebody out of state slams into you or you into them, and they have 25,000 of coverage, and you're injured, or you have, like, what are you going to get? So you get underinsured. And these are very nominal add-ons because the probability is low. But should it happen, and I do see it happen, especially with people, there's a lot of people driving around right now who don't have proper insurance coverages. And so this way you're also covered on your end should they not have the proper amount. And those are just little things that you want to take a look at. What do I have?
That's a good one. I mean, that's another one I wouldn't have thought of. Could very well have it for all I know. It's like everything I have to probably should ask my wife, but it's a good thing to think about. And the last topic that we were going to talk about on that is kind of related to this as well. You were talking about, how much someone or a family is worth, and on all of that. It plays in, like when you sign up for a job now, if you're working in a big company, a lot of times life insurance or some version of it might be included, right? The benefits you're reading, oh, I got a 401k, oh, they have a life insurance. But then you say, well, do I want something on my own that's in addition to that? And so what's the math there usually? Because life insurance is something, again, this is the first the conversation with insurance is, oh, we don't talk about it until we need it. Obviously, this one is even more extreme in that way, is that people sort of have, there's some sort of a, skepticism in some people's brains. Well, I don't want to talk about that because I don't want to think about
exactly
that I'm going to die someday. But the idea of life insurance, how do you do the math there when you're talking to clients?
Well, just to jump off what you said about when you sign up for your employer, one of the benefits of signing up with employer life insurance coverage is that there's no medical required if you sign up when you first sign on to the firm. If you pass on it and want to add it later, then a medical is required, which might be fine if you're in great health. But if you're in not so great health, you're going to find out later on that you should have added it when you first. That's
interesting, because if you're not in such great health when you sign on, there's no medical. They don't.
There's no medical. Then you want to sign out the max. Now, they're going to cap it at maybe 2 or 3 times your salary. So it's certainly something. It may not be all that you need, which gets to your question. And the first thing you have to look at is your mortgage. That's, you want to make sure that if you have a spouse that you're going to leave behind in this example, that at least the mortgage possibility could be paid off. You also want to think about, like, hey, if my kids aren't fully funded for college, what's that math? I would add that onto the list. And here's a classic example. When you're young and you have all of your working life ahead of you and the biggest mortgage and the littlest amount of money saved for both retirement and the kids, that's when your need is the greatest. And then as
Right.
you age, and even though the probability is is higher that you're not going to be here, maybe the mortgage is paid down, the kids are behind you, and the need actually in your mortgage, so it pays off. So other debts and things, and then it's really the only other variable is how much of sort of income do you want to leave behind for your spouse. And so it's funny, sometimes clients will tell me, hey, listen, I don't want to make my wife's future husband rich. So if I'm not here, so there's a line, but perhaps there's some amount that I do want to cover for.
I'll be all right, but I don't need this guy driving around. And that's classic. And that has happened, right? You've definitely heard that.
Yeah. And that has happened. So it's just, real quick math is that there's formulas online you can certainly check out to give you some estimates. And so if you're younger and you're trying to keep costs down, that's where term insurance is the cheapest, biggest bang for your buck. But term insurance is very simply this: if you don't die, you wasted your money. So of course we hope you wasted your money, because for you to cash in, you would have had to die. And the permanent insurance, which a lot of insurance agents will want to sell you, because there's a lot more commission in it. It's a longer term commitment. It builds cash value, but it requires a lot more of a commitment in terms of dollars. And there are some benefits to it, but typically the big high need could get covered by term, but term insurance doesn't mostly take you past age 70. And so there's possibly some small amount that you should or want to have on a permanent basis. And that combination typically works really well. Not having all of one or the other is probably not the best idea, but each circumstance is different. So those are things to look at in terms of quantifying the amount. And so take that amount at your employer that you can get, and then we'll look elsewhere for outside. The thing about that is when you leave your employer, you can't take that with you. So you might want to have your own personal policy.
That was right. You can't take it with you I went to Catholic school, and there was we had a nun who used to teach us. Her name was Sister Joan Duty, which is another story, obviously, in and of itself. But outside the window of the school, you could see the church, because it was a Catholic school. And many mornings there'd be a funeral at about 9 or 9:30 in the morning. And she would make the whole class stand up and go to the window and say, do you see the hearse? You never see a U-Haul behind the hearse because you can't take it with you. So she would always remind us of that. So it's the same kind of concept. You can't take these material items with you either.
No.
So lessons.
And one of my favorite sayings from a client was, not only can't you take it with you, you can't send it ahead and you can't come back and get it.
That's true.
It's a balance of, I want to live enough for today. I want to protect myself and my family, but what if I am around a really long time? It's balancing all of those things. And this is just one part of the entire picture with financial planning, and certainly insurance plays a part in that.
Plus my favorite one that you shared, don't make the next dude rich, which was your client.
Yes.
Any of those clients die, by the way? Okay.
Sometimes, and sometimes they tell me that on the way out when the spouse is down the line, hey, listen.
Hey, just so you know,
it's
whispering.
A passing comment. So
I'll catch up to you at the elevator. I just got to talk to Doug about one thing before I go.
Yeah, exactly. One of those come. So
I know she's going to get
remarried.
remarried. And this dude, just a few bucks is fine for her, but I can't have him driving around in a G-Wagon or something like that.
Exactly.
Anyway, what a world. So I hope people learned something. Again, like I said earlier, I'll take away the 80% rule as a good way to check tonight to make sure you're updated on things like homeowners insurance. I know people are thinking about it a lot with what's going on in California. We didn't even go into health insurance at all. No. Kind of Luigi Mangione debates, which is crazy that there is a debate that we're debating whether or not it's okay to shoot people in this country. But that's another story. Maybe we could do another podcast on health insurance someday. But this was good. I think we learned a lot, right? So
hopefully,
the podcast is called No Dumb Questions. So if you have any. Ironic, because I spend most of it asking Doug dumb questions. But if you have any questions, when we post this, which we always do on our social platforms, and it's available, as you know, wherever podcasts can be listened to, there's always a comment section. So maybe leave a comment or a not so dumb question, and maybe get an idea for a future podcast. But thanks for listening today. For Doug Flynn, I'm Connell McShane on No Dumb Questions. We'll talk to you guys next time.